Welcome, EasyEquities community, to this webinar. And for those of you I haven't had the pleasure to meet, my name is Carl. I'm our Chief Enablement Officer, and it's always great to talk to the EasyEquities community. And today I'm joined by Trinisha. Trinisha is from 91, and our community loves smart people. And so I'm delighted that Trinisha, who is not only a smart actuary, but also somebody who speaks passionately and well about all things investment, has joined us. So big thanks, Trinisha, for joining us. Nice to have you.
Thank you, Carl. That was a lovely introduction.
All true, and our audience also knows that 91 is one of South Africa's most successful global investment managers, founded in South Africa, proudly so. And I think you guys manage close to 3 trillion in client assets around the world. And your business is certainly known for its active investment expertise and a long track record of helping South Africans build wealth. So we're talking to you because you've launched some new actively managed ETFs, and of course they're available on EasyEquities. And 91 were keen to chat to our community a little bit about them. So I'm going to jump right into it, Tanisha, because your job, one of your jobs at 91, is to look after the actively managed ETF. So maybe to start off, tell us why 91 decided to list some actively managed ETFs.
Perfect, Carl. Thank you for that. So, we were a business. Next year we celebrate 35 years of investment expertise. And as you said in that intro, our core purpose has always been to help clients deliver their investment results through active management. Historically, when you traded on exchange, you really were you were limited in your choices to passive investments. Those were exchange traded funds where you had to track an index. So the index provider would tell you what to buy in what proportion. And as an investor, you would earn exactly what that index delivered. And we really do believe that the markets, it's possible to, with thoughtful research-led investing, you should be able to find investment opportunities where you're able to outperform the market. And now more than ever, I think the environment is ripe for that type of innovation. So for many years around the globe, on exchanges, the rules limited the types of products that could be listed, and those types of products were limited to index tracking alternatives. And in the last 2 years around the globe, including South Africa, there's been a change in the regulatory listing requirements, and it's now possible to have actively managed solutions. So that's one of the reasons, why we chose to enter the market now. That's more a product and a regulatory type of reason. The other reason is that the global ETF industry at the moment is larger than you would think. So it's currently 17 trillion US dollars. It's growing really fast. So it's growing at about 20% per year. That's around the globe. Some people think that is a US specific story, but whilst the assets are predominantly in the US, the growth is happening around the world. It's actually happening faster in Europe and Asia and in South Africa than it is in the US. And the reason why is interesting, right? It's because the investors themselves are demanding change. Investors nowadays want to trade online, they want to trade on digital apps, and that is only possible if you trade on an exchange. So it's a bit of regulation, but it's a lot to do with consumers demanding an experience that they're more familiar with. I am an avid online shopper. I'm sure most of us, because of the convenience it offers, buy groceries, for example, online, and there's no reason if you're banking, if you're shopping, everything these days you can do from the palm of your hand, why you shouldn't be able to invest on the exchange digitally.
Fantastic. Thanks very much for all of that. It's really useful information. You can correct me here because you'll know better than me, but ETFs were started in South Africa in 2000 with the first Satrix one, and that market's grown tremendously. Actively managed ETFs have been around for a much shorter period, but we're up to about 30 already. Is that true? I mean, we've got 3, you've launched these 2 now. So I think it's about 30, and you guys are probably going to be rolling out more in the not too distant future, I would imagine.
Absolutely. So ETFs have become, I think very much the norm. They used to be a niche product, but they've been around for a long time and they're well established in South Africa and around the globe. So South Africa's launched its first ETFs 25 years ago, around the same time that Europe launched their first ETFs, right? So we really are, as an investment industry, on par with what's happening globally. But, as an industry, I think ETFs kind of plateaued for a while, and in the last 5 years or so, there's been significant growth. And that growth, like you rightly say, has been driven by, the introduction of active managers being able to come to the market. Actively managed ETFs were only allowed in the JSE 2 years ago. And within those 2 years, there's now more than 100 actively managed products if you count the exchange traded funds and you count the exchange, the notes that are available. So anything with an active feel to it, there's more than 100 out of 285 products, right? So there's significantly more product that's launched in the last 2 years. And absolutely right. So as 91, as a manager, our strategies have been available to investors and relied upon for the last 35 years. And we want to make those same tried and tested strategies available to investors from whichever platform they choose. So if they prefer to trade on a traditional list platform and buy the unit trust format, then they can very much continue to do so. We don't think that there's going to be like a death of the unit trust industry and everyone's going to migrate to the listed exchanges. But if you prefer to trade on exchange, and there might be various reasons, and those reasons might, they straddle a whole range of outcomes. So if you're a very sophisticated investor who wants intraday trading and you want to get in and out throughout the day and you want to know exactly what price you're trading at, then the ETFs might be a good option for you because you now can do that. But if, even if you are a man on the street, investing on the exchange is as easy as 1, 2, 3. You should be able to contact a platform like EasyEquities. It's really quick and easy to sign up. You really just have to search for the product that you want, fund your investment, and off you go. So there's a whole lot of, I think, people that are sitting in retail bank deposits where they might be able to now come and join us in the markets now that the products are available on exchange and are arguably easier, or there's more transparency. You can see what you're buying, you can see, and I think people feel safer knowing that they can see the investment journey as it's kind of unfolding.
Before we talk specifically about your two new products, maybe just to close a little bit around this, there are some people who say that actively managed ETFs will be the death of unit trusts. Now, unit trusts are massive in this country, massive for you. Do you think that that's true? Do you think there's a place for both those types of products, or do you think everybody must now get out of unit trusts and run for actively managed ETFs?
No, so I think our view is that there's definitely a place for both products. If I can give you an example of myself, I've been a unit trust investor for many, many years. I started at 90. I started my career at 91, and I suppose the more you know about something, the more you trust it, the more you invest in it. So, I personally have invested in unit trusts for many years, and I wouldn't switch all my unit trust holdings to actively managed ETFs, even if all of the strategies were available, because I don't necessarily believe I need to trade intraday because I'm investing the bulk of my savings for my children's education or for retirement. And so those are just monthly contributions going in the unit trust. I'm very happy with the unit trust. But on the other hand, I am about to move to Cape Town, and I've just sold my house. And so our diversified income actively managed ETF, which we've launched, is the perfect product for me for that particular need, because I want to invest for a year, while we settle, while we find our feet, while we find a home, and having that on exchange where I might be able to, I might need to make a deposit really quickly and easily, for that purpose the actively managed ETF will serve me well. So I really think it depends on the investor. It depends on your preferences and why you are investing. And, you know, whether you need the efficiencies the ETF can offer or whether you need the access it can offer versus whether you're happy to trade or to invest via unit trust in a platform, you know. So it really comes down to the preferences of the investor. For your information, our unit trust and actively managed strategies are priced identically. So there's no difference in cost. And therefore, it really should just be what suits you as an investor.
Great, thank you so much. And it boils down to that there's not one size fits all, and that people really should do their research. And there's a wealth of material, you know, on our EasyEquities Academy, but also your site. There's some fantastic bits of information about investment generally, and then specifically about your products. So let's jump into the two that you've listed. There's the 91 DINC and the 91 GINC. It's always interesting how the names come up, but I love that 91 is in there, and the EasyEquities community is going to hear a lot more about 91 because the 91 team have got some fantastic opportunities for EasyEquities clients to win some cash in their portfolios as part of their education drive and getting to know more about actively managed ETFs overall, and specifically these two products. So that'll be on the social media, but let's start locally. And maybe you can tell us, and you started a bit now, but what is the strategy behind the 91 DINC? It's regulation 28 compliant, right? So it's across bonds, credit, cash, property, and a bit of offshore. So yeah, maybe just talk a little bit about the balance of income, stability, growth, and about this local.
Sure. So we're listing two new strategies, or we listed two new strategies last week. The 91 DINC is our diversified income strategy. That strategy is predominantly a South African income strategy. It invests across fixed income asset classes, and it's ideally suited for investors who are sitting on excess cash. They want to sweat that cash a bit more. It targets 1.5% to 2% above SA cash. So it's currently yielding close to 9% after fees. And if you think about if you are sitting in a stockbroking account and earning somewhere close to 6.5%, or you're sitting in an overnight cash account, you know, that 9% pickup is really nice compared. It's like a 2.5% additional yield that you're getting from the fund. But always with a very strong capital preservation mindset. So our fund, I think what sets it apart is that even though we are invested across those fixed income asset classes, our managers are always keen not to lose capital. And when we say lose capital, your capital isn't guaranteed, but we don't want to have a negative 3-month worth of returns. And I think the test really comes into looking at what we delivered during COVID. So COVID was a real life stress test. And in that COVID period, we did not have 3 months of negative returns, which I think demonstrates how important that capital preservation bias is. On our global income fund, that's the 91 GINC fund. It's run on a very similar basis. So also suited for investors. Are you looking for US dollar yields plus 1.5%, but all traded in rands, and invest across very similar asset classes, but all offshore. So developed market bonds, emerging market bonds, cash, offshore credit, with the same capital preservation bias. So we've never had a negative return, a month of negative returns on that fund. And essentially, I guess the 3 points you really need to think about when you think about these funds. The first one, we're looking to sweat your cash. So we want to give you returns of 1.5% of 2% above cash. So that's if you're earning 7%, you're now earning 9%. If you're earning 5%, you know, you earn 5% in US dollars in our fund versus say 3.5%, 4% in a US dollar retail deposit. So you're enhancing cash, but you are quite confident that your capital is going to be preserved because of the philosophy and the way we manage the fund. And then you are diversified across more than 100 instruments in each fund in a single trade. So I think it's returns, capital, and diversification. Those are the three points around each of them.
I think that's well summarized. And then maybe also to add the point that you made around cost. It's not as if you are adding layers and layers of cost in providing, for instance, that large spread of diversification. It's not as if it's an expensive product. I think it's also useful.
Yeah, so on the costs, I mean, both of these funds, there is an annual management fee that's priced into the fund. Those yields of 9% in rands for our diversified income strategy and 5% in dollars converted to rands in our global strategy, that is net of fees, right? So we have a 0.45% annual fee on each of these strategies. But any return or yield that I've been quoting you is really after fees. So you're getting a 2.5% pickup after fees. And you're getting all the benefits of, we've got one of the, I think, largest and most experienced fixed income teams in the country that are managing these portfolios. People that sit in South Africa, we've got investment professionals that sit globally. And so you're getting all that expertise in one portfolio with a single trade.
Fantastic. So, Tisha, as we said, there's a lot of information on your site and certainly on EasyEquities, and we're going to be driving hard actively managed ETFs as an asset class for our 1.2 million active clients to consider, expose them to your actively managed ETFs and also the others that are available. So lots of information. But I'm keen to abuse your time a little bit in the last few minutes that we've got, because it's interesting always for our community, and we're passionate about the fact that our community is pretty much evenly balanced in terms of gender, which is something we work hard at. And our head of marketing is a woman, Carly Estrazer. Maybe you can talk for a minute or two about your journey in financial services. I mean, you said you started at 91. You're an actuary. Why aren't you working at an insurance company? What is it that keeps you at 91 and in this world of asset management and rolling out actively managed ETFs? I mean, is it supremely boring? Is it exciting? Yeah, just talk a little bit about that.
So, Carl, all the cool actuaries work in investments. Right? I'll open with that gambit. But no, it's a funny story, and I wasn't expecting that question. But it's funny how life takes you on a path. When I was at university, I actually had no idea which industry I wanted to land up in. And what I did know is that pensions as a subject seemed very boring. So did life insurance. And so in my time, it was pensions, life insurance. There was investments, but there weren't many investment people out there. I had quite a crazy honors year. And as a result, I didn't go for many interviews, but I started my career at a life company just because that was the easy job and I needed to get a job and then focus on studying. And my first job was at Investec Asset Management, but I really went to interview thinking that I needed some interview experience. I didn't really intend taking the job. It was in Cape Town at the time. It was 20 years ago. So I'm giving away my age. I started my job there and it was just, the markets are so interesting. They change every day. You learn about new companies. You learn about, how the world is working through your work. So we really are blessed because you never do the same thing twice. And I started my career in the product development team. And that team was really, I couldn't tell you that you should buy Anglos because at this price, because you're going to make lots of money. But I did have a bird's eye view of how Investec at the time operated. And so it was fascinating, and then for my sins, 7 years later, I left and I joined Absa Capital to list the new platinum ETF, which if any of your investors are in there, would all be smiling all the way to the bank because gold and platinum has been amazing. And I, in fact, at the time listed the 5 passive ETFs, so Swix 40, Gavi, ILB, that are now with Satrix, was subsequently sold to Satrix. And at the time, I must be very honest, I was almost suicidal because I'd come from this active management mindset. And now someone said to me, list these passive products. And I was thinking, why would we do this? But you know, the ETF industry 25 years later has come to the fore, and passive products for a long time, I think, have been the easy money. It's been cheap and it's giving you access. But you know, I am an active believer at heart, and that's not because I work at 91. I do believe that there is
Value in that.
return on the table, and
Mm.
with the right people, you can eke out additional returns, and 1 or 2% every year. I mean, I am an actuary by trade. Over 40 years of retirement horizon can substantially influence whether you're on track for retirement or not. But to your point around, you know, just being a female in an investment industry, I think there's no limit to this industry. You know, it's full of excitement. You learn things new, like new things every day. And yeah, I would encourage anyone to come and join the ETF, the investment industry. It's a wonderful place to be. And there is I mean, personally, there is a lot of joy in helping people see their money grow. And in my last job, I used to spend a lot of time talking to retirees on how to make sure that they end up with the right amount of money. And, you know, the one thing I will say is you've obviously got to pick a manager that does the right thing for you. But more than that, there's only so much you can get out of the markets. You can get a lot out of the markets, but if you don't save enough and you don't start early enough, no manager can save you, you know. And I think that's the danger that most people actually find themselves in, is they are so consumed with all the, you know, the luxuries that are out there, and wanting to own all of those things. And you know, you really, if I can say, I am a typical actually, you should be saving 15 to 17.5% of your salary for retirement only. That's how much you should be saving. And if you're not doing it over 40 years, if you haven't started yet, the best advice I can give you is to start now. Because no manager, no matter how talented they are, can make up the gap of you not saving enough. So
Fantastic stories there. So thank you very much, and I couldn't agree with you more. And with platforms like EasyEquities, the products we've been speaking about today from 91, there's also no excuse about not starting. You know, there's no minimums. There's lots of education around. And one of the things I love in my job is interviewing, as I said, smart people like you for our smart community, and not prepping questions. You know, lights will go off, things will happen. Because investment shouldn't be the scary or weird thing. It's for all of us, normal people. It's our money. It's interesting. It should be interesting. It should be fun. And there should be no questions that people are scared to ask or answer. So yeah, thank you very much, Tanisha. The community will learn lots more about the new products from 91, your two actively managed ETFs. As I said, there's going to be some wonderful money up for grabs for people in their portfolios. And so thank you very much to you and the excellent team from 91. And we wish you very well with both of these products. And we look forward to many more coming onto the exchange. And, you know, we've had a weekend of Bafana and Proteas and Springboks winning. But, you know, our JSE that often gets lambasted, and sometimes fairly so, I'm sure. But when people say there are no listings, you know, maybe it's equity listings, although we've had Optasia and others. But there are a wealth, as you've said, of listings that are happening on the JSE, and there are a wonderful range of products that one can choose from. So check out the 91 products, and thank you very much for your time, Tanisha.
pleasure. Thank you, Carl.